Welcome, everybody. My name is Jason Barcima. I'm the co-founder and president of Halo Investing. Certainly an interesting topic given today. I was going to start off today on a very positive note, given the weather and kind of the party-like atmosphere that we're having. And then you see the Dow drop almost 1,300 points, which is suboptimal for portfolios. But at the end of the day, that's exactly the reason why Halo was created, was to defend against these uncertain times, defend against rising inflation, rising interest rates, and rising volatility, which we'll get into in a second. But when you look at the future of portfolio management, obviously the markets are changing, people's lives are changing, demographics are changing in this country, but the way that we manage portfolios hasn't been changing. It's that traditional 60-40 portfolio that everyone's been talking about. Now maybe we mix in a little private equity and venture capital for the alt side, but we're not really talking about the structured note side. And structured notes, when used correctly, can be one of the most elegant tools in your portfolio to bridge that risk gap between stocks and bonds and ultimately defend against the rising interest rate and uncertain market that we're dealing with right now. I'll get into that more in a second, but as a quick overview in regards to Halo, Halo is a marketplace for financial advisors that has disrupted and democratized the $3 trillion market of structured notes. So a lot of people don't recognize how big the structured note market is globally. It's a very niche product here in the United States. But again, it's a $3 trillion market globally, meaning $3 trillion of structured notes are outstanding around the world. $1 trillion of structured notes get issued around the world every single year. Now, in the United States, about $60 to $70 billion get issued every year, but compare that to Europe, where about $400 billion get issued every single year, and in Asia, about $550 billion get issued every single year. It's a huge market that's been around actually since the 1970s. Now, with that, if you're familiar with structured notes, and who here is familiar with structured notes? Has everyone ever heard of the product? Oh, that makes my job a lot easier. Usually like the first 15 minutes is explaining what the hell a structured note actually is. And so we get to avoid a lot of that. But if you're familiar with structured notes, then you're familiar with a lot of the problems, right? And a lot of the problems, at least that I had, because I spent my career at Credit Suisse. I was a partner there on the private banking side, managing portfolios for ultra high net worth individuals and institutions. And in sum, I always say about structured notes, they're one of the most elegant products in theory, one of the most inefficient that I've ever seen in practice. And a lot of those inefficiencies come from the high fees, the lack of liquidity, the lack of transparency. They're overly complicated. You have concentrated issuer risk. And buying and managing a product was like working with a travel agent before Orbitz, right? You know, very cumbersome, very manual. And really what we wanted to do at Halo is we wanted to disrupt this space by bringing technology to the manufacturers of these products, which are big banks who issue these structured notes. So these issuers utilize our technology to automate the manufacturing process, ultimately removing about 70% of the manufacturing costs. And as a result, they can pass a lot of those savings on to the customer or the financial advisor in regards to better investment terms, better liquidity, and more transparency. But the other side of our platform is for financial advisors, which is what we'll be talking today. And so with that financial advisor platform, you not only get access to structured notes, but it's about the creature comfort. So education, so your clients can actually understand what this is instead of having to send out 80-page term sheets that no one gets. A full suite of analytics so you can understand the risk and reward of structured notes and where they actually go in your portfolio statistically. And then click the trade tool so you can seamlessly buy these structured notes, deliver into your custodian, all with a click of a button instead of all the back and forth manual phone calls that we've got. Now, when you look at Halo, we launched in full force in the fall of 2017. And so, just about 5 years ago, we launched our beta in the fall of 2016. So fast forward 5 years, we went from just 2 banks on the platform as issuers and a handful of RIAs to now having 30 issuers on our platform globally. We've got about 15 to 17 in the United States today. We serve thousands of RIA firms in the United States, and now we expand across 5 continents with our global headquarters in Chicago, but we have offices in Zurich, Abu Dhabi, and in Singapore. Last year, we did about $7 billion in gross product sales, which has made us in the top 10 fintechs in the United States, at least according to Fast Company magazine. And we recently raised our Series C equity round of over $100 million of capital from venture capitalists like Owl Capital, Mubadala, and others, which was a really exciting time for the company. Now, to that point, we're going to talk more about the platform today, but for the advisors out there, Halo is more than just technology because we also recognize that this is a complex product. So some of the benefits that we deliver at Halo, besides just the platform, is a full team of marketplace sales professionals. So in the United States, we have 25 sales professionals that will handhold you, even handhold your clients in regards to what are structured notes, where do they go in the portfolio, what are the optimal products for you to be buying and pricing in your portfolio. You can do all this with a click of a button on the platform, but recognizing this can be a complex product and new product for many people, take comfort with no additional cost that you got a full team of relationship managers out in the field to help guide you through that process. And Halo is also a broker dealer. So the way that we work is that we onboard all of the issuers on one side, we onboard RIAs and broker dealers on the other side, and then we plug into all the different custodians. So when you want to buy a structured note, we deliver that seamlessly into virtually any custodian that you work with. So we do not custody the asset. We just make it very clean and easy for you to have that position delivered into the account at actually $1,000 minimums, which is very unique for structured notes. As many of you know, the client minimums have been traditionally very high. The minimums on our platform are $1,000. We talked about the investors, but really about the platform is in regards to the automation. What I love about structured notes in general, and we'll talk more about structured notes than we will about Halo, is it's really where I think the future of wealth management is going. And really the three key themes that I think, in my humble opinion, of where the future of wealth management is going is number one is the personalization, right? Everything in our lives is customized. Your Netflix, your Amazon, your Google is all customized to you, but your investment solutions are not, right? Ultimately, you have a 60-40 portfolio, but you're forced to be delta one. You're either long or you're short. But some of us might want 20% downside protection against market declines. Some of us, like my father, want 40% downside protection against market declines. That's okay. Each one of our investment needs and preferences are unique to us. And so we should be able to customize that. And that's the benefit of structured notes, is that they can be whatever you want them to be. They can be tailored to anything that you want. On Halo's platform, we have 3 billion combinations of structured notes. You can buy a structured note anywhere from 3 months in maturity to 10 years in maturity. You can do baskets. You can do indices. We've got 16,500 underlyings. So if you want to buy a structured note linked to a currency, a commodity, an interest rate, a stock, an ETF, whatever you want, you can do it directly right through the platform. The second trend that I see going on in wealth management, which is where structured notes can be really value add, is more the defined outcome style. So, at least in my practice at Credit Suisse, I had 2 very specific mandates from my clients. It was typically make me 5 to 7% of my money and don't lose my money. No matter who I talked to, no matter what institution it was, it usually fell in that bucket. And what's really interesting about what I used to do at CS was more about, I took my asset allocation so seriously. I was like, okay, should I be 23% US equity or 25% US equity? Is it 15% international developed or 17%? At the end of the day, and pardon my language, like my clients didn't give a shit. At the end of the day, when we reviewed their portfolio at the end of the quarter is, how much am I worth? How much did you make me? And how did I compare against what my objective was? That was it. And what I loved about structured notes, again, forget about Halo for a second, is that it allowed me to tailor around my clients' individual risk profiles. So for my family who wants to make 6% on their money, I could buy an income note that, we see some questions going in here, which is good. But getting back to my original example, for my family, they want to make 6% on their money. I typically buy a 3-year income note linked to a few major indices, 30% downside protection. And on average, I get 9 to 10% per annum. For me and my family, that's a no-brainer. My family wants to make 6. I'm getting 9 to 10% per annum with 30% downside protection. That's okay. And that's, in my opinion, that's really where the future of wealth management is going, is really targeting in on those defined allocations. And then the third trend that I see is really about protective investing, right? And so with protective investing, ultimately, we have a home with insurance on it. We drive a car with insurance, but we don't invest without insurance. And that doesn't make any sense to me, right? We don't know what the future holds within the markets. We don't know when our clients need liquidity. We don't know when they need capital. And having that downside, comfort of the cushion, I think really helps not only just with hitting your clients' investment objectives, but really managing the art behind it, the psychology with your investors and with your end clients. I did see a few questions coming in, and I'd love to be able to answer some of those. And so the first question is, how should we think about allocation to structured notes? Is there a general percentage advisors are targeting? It's a very good question, and I'll answer it three ways. When you look at kind of the wirehouse where I came from of Credit Suisse, our typical allocation at the firm on average was 17.5% of the portfolio. My allocation was 20%. Within my family office, it's 25%. And so I had a typically higher allocation to structured notes because my clients like the downside of the downside protection against market declines. Now, with that, many people are new to structured notes. So I always say start off small. Start off with a 3% or 5% allocation in the portfolio. Start with something simple that you can easily explain to your client because it is a new concept, and then work your way up into a more appropriate allocation of the 10 to 15%. At the 10 to 15%, which again, you can use Halo to see the impact that these products have on the portfolio, you can actually see that they actually have a positive impact of lowering risk in the portfolio and increasing the Sharpe ratio within portfolios. Another question I got is, what about the allocation to counterparty risk? And it's a good question because one of the opportunity costs with structured notes is that there's counterparty risk. That's one of the trade-offs. So yes, you get protection. Yes, you can get a defined outcome, but these products are issued by banks like a Citigroup, like a Morgan Stanley, like a Bank of America. And when buying a structured note, you have to be comfortable with the issuer who's issuing them. We all remember Lehman Brothers in 2008 and 2009. Thank goodness I didn't have any Lehman exposure, but a lot of my friends did. Those that had Lehman exposure recouped about 30 to 35 cents on the dollar. It was a real problem. And so you have to be very comfortable with that counterparty risk. And that's something, again, that we try to always educate all of our advisors on in regards to transparency. What I personally do is I don't keep any more than 2 to 3% in my portfolio allocated to any given issuer. So again, we've got 15 to 17 issuers, all high quality issuers. Keep about 2 to 3% of the total portfolio to any given issuer so you're fully diversified. What's interesting, in the next, call it 9 to 12 months, we're going to be rolling out with non-bank counterparties, which will be a world's first. So you'll be able to diversify beyond just the traditional banks within your structured note portfolio to non-bank issuers. When you look at the last question, then we can move on to some of the other points in the technology. But when you look at, do you like buffered ETFs, is a question that I just received. Halo is a protective investing platform. So we've got structured notes, we've got annuities, we've got buffered ETFs, same value proposition. We automate a lot of the issuance side for annuity providers, structured note providers, buffered ETFs, and then we digitally connect them to financial advisors so you can easily get educated, analyze, and execute all three of these products. On the buffered ETF side, I have no economic incentive to say I like structured notes better than buffered ETFs. It's just a different tool within your portfolio. The benefits of a buffered ETF is that they're completely liquid. They're exchange traded. And so they're traded on we deal with a particular product from Allianz that's traded on the New York Stock Exchange. And so you've got liquidity from the New York Stock Exchange, the market makers on there. There's no counterparty risk because they use exchange traded options. That's another benefit of a buffered ETF. And you can buy one share of a buffered ETF for $25, which is also quite novel. On Halo, buying a structured note for $1,000, but $25 is interesting. I like to look at buffered ETFs as a good starter product. What I don't like about buffered ETFs is that they're very vanilla. You don't get all the choices that you do with structured notes. You get one maturity, which is 1 year. You get a few different underlying exposures. You get a couple different protections. But for those of us who really want to tailor it around our personal investment decisions, you can't do that with buffered ETFs. So again, there's the risk and reward. And because there is no counterparty risk and buffered ETFs are exchange traded, many times the terms of the buffered ETF are not as attractive as a structured note. So again, the pros and the cons. The last question that I'll answer here is in regards to liquidity. So we get this all the time. Are structured notes liquid? And the answer is yes, structured notes are liquid. So with Halo, we connect you primarily back to the issuer who sold it, and they will provide liquidity on that structured note. But in certain circumstances, we do have access to third-party liquidity providers who will make markets in your notes. And the liquidity of the structured note market has gotten dramatically better since 2008 and 2009. And there's a number of different initiatives Halo is actually taking to turn this market into more of a full-blown exchange for structured notes to further compress the secondary prices of the product. Getting back to, I guess the operations and some of the technology, what I love about Halo is also allows you to take advantage of volatility and time. So if you've ever bought a structured note before, you're used to having to pick up the phone, call a wholesaler, they'll call the banks call back the wholesaler, then they call back you. And each one of those iterations takes about 3 hours, as we all know, just for the pricing iteration. All in to buy a structured note, it can take 2 to 3 days. What I always hated about that process at Credit Suisse is that I was never able to execute when I wanted to execute. So on days like today when the VIX pops, I'm getting exponentially better terms today than I would be maybe 2 days out when the VIX normalizes. With Halo, we've changed that. So we've developed our own auto pricer to give the power into the advisor's hands. So you can price out any combinations of structured notes that you want. We literally give you instant indicative pricing. And then, as I mentioned, you click a button to buy the product, where we make our issuers actually compete for your business. So that's another big difference about our technology is when you go and buy a product, we actually send our issuers into a competitive auction process, which extrapolates another 20 to 30% in price improvement, from the traditional ways that you've bought a structured note. The last thing, too, that I'd like to emphasize on, and then we'll leave it for more questions, is about the analytics. Something that I always used to struggle with at Credit Suisse is when my client asked me, hey, what's the probability of this product breaching the protection at maturity? How does this fit in my portfolio? Is this product actually good for my portfolio? There was no statistical way for me to explain that to my client. Besides, hey, this has 40% downside protection, and trust me, it's good for your portfolio. But nowadays, I think all of our clients and us as advisors demand to say, no, statistically prove me why this product is actually good for my portfolio. What is the historical breach rate? Show me a returns analysis and show me the risk and reward of all these products. So Halo's developed a full analytics engine for you to be able to make more informed investment decisions and ultimately allow fiduciaries to be fiduciaries. Right? Because now with higher regulations, higher scrutiny from all regulatory authorities, whether you're an advisor or a broker, is that you have to statistically prove why is this good for your portfolio. And that's ultimately what we should do. And that's what we do in regards to our technology. I'd like to open it up to a few more questions in the last 5 minutes if we have them. So in regards to the expenses that are associated with Halo, at the end of the day, we charge 20 basis points per annum. So we're very transparent about our fees. So 11 basis points more than SPY. If you look at the normal pricing model of structured notes, you would know that there could be 2, 3, 4 points embedded within these products. Again, with our technology, we've been able to reduce those expenses and those costs from the issuance side, plus from the distribution side with technology. So at the end of the day, you're paying 11 basis points more than SPY, and that's capped at 60 basis points. So if you bought a 5-year note, the most that you're going to pay is actually 60 basis points. Another question that I see up here is what type of notes are advisors looking at in today's market? And I'll answer that in 2 different ways. Number one is notes that I've been looking at personally have been more of these income notes. Again, with rising interest rates, rising volatility, and rising uncertainty, I like the ability to lock in these yields within my portfolios. And so I talked about earlier about those 3-year income notes that were linked to the S&P, the Russell, and Euro Stoxx 50. That's just what I do. That's, again, global equity within your portfolio. In normal times, those products are around 9 to 10% per annum yield. Right now, depending on the day that you're trading, when vol actually ticks up, I've been able to execute anywhere from 16 to 18% per annum yield with 30% downside protection. So I always go back and say, find me a long-only manager who can give me that type of risk profile, especially in an uncertain market, because I don't know where this market's going. So I like to be able to lock in that yield, and that yield pays out quarterly like a bond. And so that's also what I personally like, is that I like to get that cash flow in my account in an area and in a market where we're all trying to derive more yield within our portfolios. The other type of trade that we're seeing that's really popular is called the equity repair strategy. And so obviously if the market's down 20%, we need to go up 25% to be able to get back to par. So what we've been seeing a lot of advisors doing is buying 3-year notes or 5-year notes linked to the S&P. They've been targeting anywhere from 25 to 40% downside protection and then getting that enhanced upside. So for example, a note that I recently bought was a 5-year note linked to the S&P 500. It gave me 40% downside investment protection against the S&P. So another 40% lower from where we are today. And it gave me 120% uncapped upside. And so to talk about a few different scenarios there, in 5 years, if the market's down 0 to 40, I'm down nothing. If the market's down 41, I'm down 41 because it's soft protection. But in my mind, it's okay because I would have bought SPY or an index fund anyway. So if the S&P is down 41, I was going to be down 41% anyways. And you could go on Halo and see the statistical probability of the S&P actually being down 40% in 5 years is about 2.5%. And I'm willing to take that chance. Now on the upside, I'm getting, as I said, 120% uncapped upside. So what does that mean? Just for example, in 5 years, and the terms only matter on the maturity date, that's important to remember, if the S&P was up 100%, my note would be up 120%. And so what I really like about that is it's an equity repair strategy. So for a way for you to get into the market now, be able to get some enhanced upside more than you would be able to achieve if you bought a passive index fund or a passive ETF. And it's a good conversation with your client, right? Because again, calling your clients in markets like these can be very, very challenging because they're like, you want to put fresh cash to work? Like what happens if the Fed keeps on raising interest rates? Should we be holding cash? You know, Bank of America came out with a study today that showed that there's more cash on the sidelines than there's been in the last 20 years, which is really, really interesting. So deploying cash in these types of markets can be very challenging to have that conversation with your customer. But if you go into that conversation saying, yes, we are moderately bullish in the market, we are going to get that enhanced upside, but if I, the advisor, are wrong, AKA early, it's okay, I have that 40% downside protection. And this was the strategy that I used in early 2009, and it made my clients feel very comfortable. A question I just got is, has any of your notes matured without the protection you advertised? And so maybe I'll ask who asked that question just so I'm clear on what the question actually was. Okay, maybe I'll just take it as how I think it is. And so at the end of the day with Halo is we don't sell any product, right? And so we have the advisor go onto the platform and you customize what you want. So oftentimes I get the question of, hey, how have structured notes performed in this market? I'm like, well, it's like asking how ETFs performed in this market. It's kind of an irrelevant question because structured notes can be linked to interest rates, can be linked to currencies, can be linked to equities, whatever the advisor wants. And so at the end of the day, you have to looking at that question as, has it ever matured without the protection that we wanted? No, the terms are the terms. The only times that those terms won't be the terms is if the issuer becomes insolvent. And that goes back to making sure you're very comfortable with the counterparty risk that you're taking. As long as the issuer is solvent, the terms are the terms on the structured note. And that's what I like. What you see is what you get. The last question is, how do I fit in the ecosystem along iCapital, Case, Fidelity, and other banks? Do we fit on top of those platforms alongside them? Halo is very different, right? So when you look at Halo in our platform from more the traditional wholesalers like a Case or like a InCapital and others or First Trust, nothing against any of the other competition out there. Our platform is more technology driven. So again, we're not here to sell any product. We're here to give you a platform to get educated, analyze, and execute, which is a difference between a traditional wholesaler. When you look at iCapital, their platform is actually owned, is a platform called Simon that they just acquired. And that's more of a bank-owned consortium, which is totally cool. The predominant owners of that are Goldman Sachs, JP Morgan, Wells Fargo, Credit Suisse, and Barclays. And so the approach that we take is really more about being independent agnostic. And part of my problem with the structured note industry was that these products, again, have always been sold and not bought. And it's always been the issuers who have controlled the market and not the buy side, not the advisors. And Halo is a platform that's built for the buy side by the buy side. And so none of my investors are the issuers. And that way you ensure that you get the best pricing, the best transparency, and unbiased analytics. So you can do what's good for you, not what the banks want you to do. And so with that, that is the end, I guess, of my time and my presentation. I truly appreciate all the different questions. And we're here to follow up after the presentation with anything else you need. Thank you very much.